Okay, let's see here.
Like if you're in the press, you're not aware that there's other people. Yeah, it's kind of like it's kind of like it's still kind of like it's like
As far as I'm concerned, to me, this guy is not that.
Econ, I attend. So let's just not. Actually, I think we should like try to five do it again. Whatever the next chapter is, I'm not sure. I thought it was over a couple periods. So
Okay, let's go. Okay, let's press on. Can you hear in the back? Okay.
I was literally looking down.
So first I'll talk a bit about your exam. We're recovering from a small crisis. If you've been in my office, you've seen that big workstation I keep on the side of the desk. It's water cooled, and even though I buy the best equipment, XSPC water coolers is supposedly the best, certainly the most expensive. The pump inside the reservoir shorted, causing a big explosion and trashing the computer. So I don't think in fact, it broke a water line, and the water line dumped on the power supply. And so that's a great way to almost burn the building down, but we got it under control. So fortunately, I not only have everything backed up, I actually have a clone of every computer I own. And so that computer is perfectly cloned. And I have to rebuild it because it's much more powerful than the clone, but yeah, I didn't lose anything or even break our stride, but that knocked about an hour and a half out of the day. So let's take a look at the exam. I sent out an email that had a detailed description of how it was graded and all of that, if you haven't seen that email yet. So again, the practice is to take the highest score achieved by anyone, assuming nobody's going to get a perfect score, because sometimes one or two of the questions have a glitch or something in it. And so you get knocked off points because the question wasn't right instead of by missing a question. And in the case of this exam, the only question that really seemed to have a glitch that would have done that's the Cisco question, because there was one of the options that was wrong on that, if you saw that graded. So what I do is take the highest score and I subtract that score from 200. And in this case, that was a score of, well, whatever 200 minus 11.1 is. And then I add those points, 11.1 points, to your score. So the score that you saw when the exam was graded, well, you probably remember the percentage rather than the score, though, if you remembered anything at all. The 200-point score that you saw, you would add 11.1 points to that, and then find that in this placement here. Or if you do remember the percent, then you add 5.55 to the percent, double that, and find the placement here. But because it's easy to forget that after you glance at it, then if you don't remember your score, then you can send me the email, as I said in the email I just sent you, please with the subject line, my exam score, question mark. That's how you get a fast response. and then I'll look up your score and just send it right back to you. With all you'll get is the score, so you'll know in case you don't remember the score. It's easy for me to respond to that. Okay? And so when you look at the distribution after that adjustment, then it came out pretty much as I thought it would. It came out very similar to the distribution I get in this class when I use essay questions as half of the distribution. Again, this is the first year that I haven't used an essay question at all because of the sheer size of the class. I was astonished to see there's 240 of you in this class. I thought it was only about 205 or 210. And so, though, like I said, the distribution came out the same even without the essays. So if you had a score of above 170 after this adjustment, then you're in the solid A category. If you have a score between 160 and 169, you're in the A- category, and on down the line. And so when you take the A's and A minuses as a percent of the total, it comes out to 59%. And I said that I wanted it about 60 to 65. And since I made that calculation, 7 people have dropped the class, as I knew would happen. That always happens. And so now that pushes the number up above 60% to about 61 or 62. So we're kind of right where I wanted us to be. And if you score down the 140 or 150, you're still in pretty good shape, but a B or B minus. And the 60% doesn't even take into account that probably as many as 20 or 30 of you will take the course pass-fail at some point. So the number of A's and A minuses for those who got a grade, not pass-fail, will actually probably be close to 70% by the time all is said and done. Although I always get 5 or 6 students who take the course pass-fail as a precaution and then end up getting an A, or would have received an A had they stayed in the grade. In fact, there's many of those as the rest of the scores for the largest part. I guess people are being sort of GPA safe when they make that move. Okay, so I was happy with that. It didn't really seem to be any problems. There's a batch of students who had extra time. One of those exams got messed up because the link was bad. The capacity to make an error compounds with each version of the exam you have to create, right? And unfortunately on that site is not designed to give this same exam to multiple parties at the same time. It's not designed to do that. So I had to kind of trick the site into doing it, and it makes it mistake prone because the only thing I can proof is the original exam. I can't proof any modified exam. So I was worried, that might cause a problem, and it ended up doing it for 5 or 6 people. But if you're in that group, don't worry about it. It's being sorted out. You're not going to be penalized for the mistake of the exam design. And until I've got some backlog to catch up on, and even more now that I have to rebuild that computer quickly. So it'll take a couple of days to get around to resolving more complicated problems on this exam if there were any. So be patient about that. It'll all work out for everybody. So I hope you're happy with the way this turned out. Generally, it's pretty much as I expected. So I'm happy with it, not dissatisfied with it. And as I said in the email, next time around, the one addition I'm going to make is it will include the terms and matching, which has always been on these exams. I had that designed, but I was really afraid of trying it out untested. I didn't want this exam to be screwed up for everybody, so I'm going to send out an exam with 10 examples to anyone who volunteers to take the 10-question exam to see how the technology is working in a week or so. And then I'll incorporate that into the next exam to make it a little bit more like the old exams that I used to give in this class. Okay, so let's keep moving then, all right? So I'm going to introduce, because we have kind of a pause here where we can slow down a bit because there's not the urgency of an exam, more and more topical issues. Now, because we're kind of catching up, I haven't been able to talk about topical issues much because we were really under the gun trying to complete all of the planned material in the timeline associated with the exam, so now we have a little bit of latitude in doing that. And I'm not only going to talk about topical materials with regard to economics or finance, actually, in the case of this. I've also decided to, because nobody else seems to be wanting to do it at Harvey Mudd, to talk to you a little bit about rapid changes in the world of computer science especially, but science and computer science in general, that are changing politically in front of us. And I think you need to be aware of some of these issues, and this college should be, in my opinion, embroiled in discussion of exactly these issues instead of ignoring them altogether. And so I'm going to bring them up a bit and piece at a time to let you know that these things are going on, that these controversies exist, that there are pro and con attitudes about these controversies, and they are very controversial. And you'll see, and I'll go about it slowly and gradually and not intensely. And you also realize politically, in this class I don't say much about it because it's hard to tie it to the subject matter. I do a lot in macro. Of course, politically the world is in the strangest form of turmoil I think I've ever seen in my entire lifetime. It's just bizarre how screwed up things are out there and how with each passing day they get even more weirdly screwed up. The decision by the Trump administration to simply abandon the Kurds in northern Syria is unconscionable, actually, and it's going to result in a catastrophe, I think, of almost unmeasurable proportions here in the next 2 or 3 weeks. And then, of course, if you're especially a student with the Asian heritage, but anyone actually who's young, the events going on in Hong Kong are no small matter, to be sure, and they're tied to events going on in China are no small matter. And the negotiations between China and the United States, which are loosely tied to it, are no small matter. And so to some extent, I think we're obliged to keep our eye on that and try to understand that as best we can, or at least acknowledge that we live in a world where it's taking place as we sort of sit here in our little insulated cocoon and pretend that it's not. I think it's very good, actually, that colleges in particular actually provide the function of protecting you from reality for 4 years so that you can kind of hone your skills to the best of your ability. I mean, you just drop into this little sort of insular little completely insulated cocoon and stay there for 4 years. Some of you never leaving the campus because you're so afraid of doing it, and others of you leaving the campus but going no more than 100 yards and then rushing back to the safety of the dormitory. And because that enables you to study what you came here to study. You know, you say, I want to be a physics major. By golly, I'm going to have like 4 years of solitude and study physics and not much else. And that's good. It does that. But of course, you're really disconnected from reality when you're doing that, especially in this world, which is really in turmoil today. So I have to kind of remind you from time to time, if others won't, and others maybe will, actually, that there are things going on out there that actually are pertinent to you and that are important even if they're not pertinent to you. So we'll have some opportunity to bring those up as time allows. So you'll see a little bit of that today. Now, so as not to scare you, how many of you are Hermann Hesse fans? Oh, that is so sad. Not one of you is a Hermann Hesse fan. So none of you, how many of you have actually read any Hesse at all? What, anything other than Steppenwolf?
I've only heard of him.
Huh?
I've only heard of him.
Oh, yeah, okay, you heard of him, okay. But you never read even Steppenwolf. But Steppenwolf is a little cartoon book for, basically for college students who can say they read Hesse, because it's the only short thing he wrote. His great novels were all 1,000 pages long. Well, I'll tell you about, he wrote a book called Magister Ludi, or The Glass Bead Game, which was about Harvey Mudd College. And he wrote it before Harvey Mudd College was created. But he knew Harvey Mudd College would be created, so he wrote a book about it. And I'll describe what he wrote in that book as time permits about Harvey Mudd College in The Glass Bead Game. You could actually go out and read it if you want. It's 1,200 pages long. But I can give you a synopsis of the plot in 5 minutes, so if you don't want to read it, I'll do that too. But not right now. Okay, watching the economy and watching the market and watching your portfolios, you know it's been a bit of a rough ride for at least some of your portfolios because we've seen a lot of activity. And we've seen some negative activity, and the market's getting a little more volatile now than it has been in recent months, and that's pretty understandable. It's partly, I think, in reaction to the sort of the economic implications of the various emerging crises going on in the world, in particular the very soured relationship between the United States and China, with regard to trade mostly, but not restricted entirely to trade. And the inability to resolve that conflict, as it seems to get worse a little bit every day, has substantial economic implications, and that will kind of roll themselves out and are doing so right now, but continue to do so over the next few months unless they're resolved. And I don't think they're going to be resolved anytime soon. They appear to be moving farther apart. And so that has an effect, obviously, upon your stock portfolios in strange ways. It depends upon how people perceive your individual stocks as being impacted by a deterioration in trade relations, especially between China and the United States. It's taking macabre turns, bizarre turns, and even comical turns. I am giving you an assignment that you cannot slack. You need to go find the South Park cartoon about performing in China that was banned by the Chinese Communist Party earlier this week. I'm giving you the assignment of watching the cartoon. It's on YouTube now. And you'll think that it's funny. It is. It's insanely funny. But it's actually also quite serious. The Chinese government is really mad about what was in that cartoon and is threatening repercussions way beyond banning South Park forever in China, which has happened. And it's not helping that the creators of South Park are apologizing with just dripping sarcasm on Twitter every single day, trying to prod the communist government to react even more strongly than they already have. So you're assigned to watch. You can just type in any Google. It's obviously very popular. Or go to YouTube and type in South Park China ban or something like that, and it'll come up. And that affects the stock market and affects your stocks. Now, I watch auto sales. If you took Econ 53 from me, you remember I told you that there are few leading indicators that are reliable for the economy, but one of those is auto sales. Auto sales and their turning points almost always lead turning points in the economy. They turn down before the economy peaks, as it peaks and goes into a recession, and they turn up before the economy fully troughs out. So as an economy is in a recession, when you start to see signs that auto sales are picking up in the category of consumer durable goods and the national income and product accounts, sometimes it's a pretty reliable estimator that the economy has peaked up. Now, right now, this isn't auto sales per se, but this is the sale of the Ford F-150 truck series, which is the most popular vehicle sold in the United States, the Ford F-150 pickup. And that turned around and, in fact, was the largest single decline since 2009, and at least year to date. And so that's kind of an indicator probably that the auto industry is slowing down. And just before the examination, I pointed out to you that the manufacturers index, which is set at 50, so growth is above 50, and the ISM manufacturers index. So slowing down is below 50, came in at a number like 47 point something, which shows generally that manufacturing in the United States is entering a recession as a sector. But manufacturing isn't very important in the United States compared to services, so that doesn't mean that GDP will follow, but it does put a drag on the GDP growth rate, and there is a reasonably good chance that, in fact, in a quarter or two, GDP will follow, and then these profits will be coming down, and if so, your stocks will be coming down with it, very possibly, along the lines we've already discussed. Now, I play earnings reports at a very large scale, in to say that a single bet that I make on a single earnings report is somewhere in the $5,000 to $10,000 range. And I usually run 30 or 40 of those in a single 2-week period. Those are coming up. And so I'm prepping. In fact, the machine I just fried is the machine I do it on, so I've got to get it repaired in time to respond to those reports. That's going to be indicative to some extent of the quarter going forward when we start to see some of these tech company earnings reports, see if they're turning down consistently or mixed or rising consistently. You had a question a moment ago.
Do we know why auto sales track the economy so well, or is that something?
Yeah, auto sales are cyclical because of the way they're financed. And so people, you'll notice in the statistics that the average vehicle age starts going up in a recession. So people, of course, are not trading in their cars, they're driving them for a longer period of time. And so the average age of the American auto fleet starts rising into 4, 5, and 6 years of the average car age. And that sort of represents pin-up demand because Americans like to buy cars. And so eventually people find themselves to where they can take the chance and take on a new auto loan, and the next thing you know, sales are rising, and back down comes that number in the average auto age. Now, this is sometimes due to the fact that financing for automobiles in a recession, because of the tendency of the Federal Reserve System to lower interest rates, financing charges drop, and it makes those automobiles more affordable in the sense that the monthly payments are lower. So up everything goes, and then the economy follows a quarter or two later. But on the other hand, people become indebted with auto debt, loans to buy the cars, and it kind of has a contractionary effect a few years later. And that's what's happening now. The average auto loan presently is approaching 7 years, which borders on the ridiculous, actually, because when I was in the 80s, it was 4 years and 6 months or so. So it's now averaging on 7 years. So the debt, therefore, associated with automobiles is kind of climbing, and that acts as a retarding effect upon the economy. It's pretty reliable, actually, as I've said. Okay. I wanted to show you, this was last year's slide, where on this day last year, we had a huge drop in the market where the Dow went down 800 points or so. On that same day, the Dow was down 823, and that turned out to be the largest drop of the year. And that was on the day where we started talking about the Dow in front of ETPs. So I thought I would leave it in from last year because that was not an indicator that the market was therefore going to turn down and the recession was going to start and everything was just going to go to hell. Because as you know, a couple more days of this, it stopped, then it rose back up again to where, in fact, the market's slightly higher now than it was around this time last year. So the point is, on any given day, when all of a sudden you see a 600 point, 700 point, 900 point drop, or 2 or 3 days of it, it doesn't mean a damn thing necessarily. It often simply means that the market is backtracking, stops after 5 days, and then reverts back to its climb. So you can't really judge much on a one-day event or even a one-week event. And this is a reminder that although it looked like the world was going to hell in a handbasket on this lecture last year, in fact, it was not. It did not really take off and recover substantially, but the market is higher now than it was on that day. So this was not the beginning of a recession. This was not even the beginning of a bear market. We never had a 20% cumulative drop in this year. And it looked like right around this time last year that we were about to begin that, but we were not. Very hard to pick turning points. Okay. Now, we rely upon Chapter 6, but my fried computer is making it very hard for me to post it up. It's literally done. But I'm going to try to have it up by tomorrow. The chapter itself, there's just, I have to proof it and convert it to PDF and then send it up. And that's why it's not there. There's not much difference in that chapter between this year and last. So if you're anxious to read, you can read last year's version. And so the Chapter 6 is detailed, it's very technical, it's very important. Because, as I point out in that chapter, exchange-traded products, typically called exchange-traded funds, but legally they're exchange-traded products, are attractive to modern-day investors. We saw in the River of Money data that they are replacing mutual funds gradually as long-term investments, and they're replacing mutual funds in retirement accounts. I'm not sure, given their liquidity, that that's a good idea, but they're doing it, whether I think it's a good idea or not. But the problem, as far as I can see, is people don't understand these products very well, and only about half of them are safe products that are suitable for being used as investment products at all, let alone in long-term retirement accounts. So the chapter labors to explain why that's true and tries to explain to you how you tell the difference between a mutual fund like safe exchange-traded fund. ETF actually refers to the safe side of this market, or something that is not safe at all, like an exchange-traded note, all of which are classified as exchange-traded funds by the popular financial media inappropriately. And most people don't understand why the so-called dangerous side of this is in fact dangerous. The reason they don't understand it is because these funds are collateralized with futures contracts, and people don't understand how futures contracts work. So this chapter 6, is actually impossible to completely understand until we completely understand what futures contracts are. So as we go through the chapter, we lay it all out, talk about the safe side of it, talk about the fees and a bunch of things we can understand, and then we end in this sort of confusing muddle by talking about the delta and leverage funds that are collateralized by futures contracts, with the promise we'll get back to understanding them a couple of chapters down the road, because unless you understand futures, you can't understand how these products work. And so it's a little hard to teach, it's a little hard to understand if you're looking at it for the first time. So we're going to do the following. We're going to take a look at the difference between the long ETFs and the inverse ETFs and leveraged ETFs. We'll look at those categories. Again, we have the italicized red terms, which will be on the second exam. We're going to look at the primary ways these things are collateralized or not collateralized. ETNs are not collateralized, as we're going to see. I'm going to show you what a delta fund is and suggest you stay away from them. We're going to take a look at a specific delta fund called USO that's very popular, United States Oil. It's an oil tracking fund. Then talk about the tracking issue and why it's a safety issue. Talk about research steps that you can employ to make sure you're buying the right kind of exchange-traded fund. And then in the appendix, we talk about how exchange-traded funds were impacted by the flash crash that we've already talked about, because they were mostly affected, not individual stocks. And then we'll talk about the specific, very grim danger of exchange-traded notes, which are out there and available for you to lose money on. So let's just systematically start going through this. Now, the reason they're so popular is because they're much more flexible than mutual funds. At first sight, they look like they're simply tradable mutual funds, and many of them are, but not all of them are. And here's how they differ. You can build a mutual fund portfolio with ETPs that match those funds, always. So you can take your mutual fund portfolio that we described, such as those complex ones I showed you at the end of that lecture, with sector funds and everything. Every single mutual fund in that portfolio has a matching counterpart, if not 10 matching counterparts, that are sold as exchange-traded products. And so you can completely build any mutual fund portfolio and convert it into any mix of ETPs that you desire. As I said in the book, I don't know how many thousands of ETPs I said there were, but there's, whatever I said, 8,000 or 9,000. Unlike mutual funds, you buy and sell these like stocks, and you can trade in them, out of them quickly. You use the exact same procedure to buy them that you use for buying stocks. You use limit orders or market orders. Bid-ask spreads work the same way and matter in exactly the same way. They are completely indistinguishable from stocks. You could be trading one without realizing it's an ETP and thinking that it's a stock. They're so similar. I trade these very, very frequently and very, very aggressively. And basically, I'm flipping in and out of these things sometimes all day long, mostly through options, though. And they're exchange-traded products, and the one I primarily trade is, the two I primarily trade are SPY and DIA. SPY is a clone of the Vanguard S&P 500 mutual fund that I told you is one of the most conservative funds that exists, and SPY tracks it perfectly. It consists of the 500 S&P stocks, and if I go into you can't even get into the Vanguard fund right now, it's closed off, but even if you're in it, you can't get out for 3 months or so, and it has very limited trading. But on SPY, you can buy it and sell it, and buy it and sell it 5 times per day if you want to. And I often am in SPY in a position for 1 or 2 hours. Same thing with DIA, that tracks the Dow Jones Industrial Average. I trade that one just as much. I'm either trading them directly or I'm trading them through options. These are tax-like stocks, and there are some exceptions that are described in the chapter that I won't bother to describe here. Now remember, the mutual funds are taxed because of internal churn potentially. Remember that? We said, sure, you can buy a mutual fund, never sell it, keep getting 1099-Bs at the end of the year saying you owe capital gains tax on this mutual fund because of the internal churn. If it's not an IRA account or a 401k account, that won't happen for ETPs. ETPs, you're taxed as a capital gain when you sell it. It's so unfair that it makes me wonder why they don't change the tax law to encourage people to make mutual funds more attractive again. But they haven't. Well, so far as I know, the Congress of the United States and the current President of the United States are absolutely incapable of passing any kind of legislation of any kind whatsoever, good or bad, about anything. It has simply turned into a national political football game that we're all watching, not unlike the Patriots versus the Clippers. No, let's see, not the Clippers. Well, yeah, actually, more like the Patriots versus the Clippers than the Patriots versus the Chargers. Okay, so one of the reasons that nothing changes is because nobody's making the effort anymore. We're just sort of watching a national soap opera. The price tracks throughout the day, unlike the NAV. The fees may be slightly higher, but they can be lower. But really, they have inverse funds. There's no such thing as an inverse mutual fund. They have leverage funds where you get 2-to-1 leverage or 3-to-1 leverage. And there's no such thing in mutual funds. And so some are designed to move in the opposite direction. We'll see multiple examples of this, of stocks. Some are designed to move with leverage, and we'll see multiple examples of that. You could invest directly in the price of some commodities like oil, gold, and silver. I have a really large position in GLD, which is the gold tracking stock. It has increased in value some, I think, 50% or 60% so far this year. It's really done well. Because, again, I read the newspaper in China in their efforts to avoid holding their reserve currency in the form of U.S. Treasury securities, have de-emphasized the purchase of U.S. Treasury securities and have substituted gold purchases for that. As soon as I read that they were considering it, I already had a large gold position, but I took a much larger gold position after reading that, and that is a bet that has really paid off. When you have a player as large as China trying to sort of establish their reserves as gold, then the price of gold is going to rise, and it's going to rise a lot, and it did. Fees are collected from collateral inventory, and we'll see what that means. That's actually a big deal. So this is kind of a summary of why they differ from mutual funds. And I usually have some kind of question on the exam about, why they're so popular relative to mutual funds, or more specifically, how they differ. Now, here's the NAV issue. Remember, for a mutual fund, the NAV is only established at the end of the day based upon closing prices of the stocks that make up the portfolio. But the NAV of a mutual fund, the NAV of any mutual fund or ETF is the total value of the assets owned by the fund and divided by the number of shares outstanding that have been issued for the fund. That's true for both mutual funds and ETPs. The mutual fund, though, the NAV is calculated each day at 4 o'clock, and all buy and sell trades are executed in the evening at that NAV price. So remember, when you buy a mutual fund, you basically place an order that tells the mutual fund administrators to make your purchase at the end of the day based upon the NAV. Whereas for the ETP, the price of the ETP is actually determined by supply and demand, not the NAV, even though for most the INAV is calculated and published frequently throughout the day, which is to say the mutual fund family like iShares will frequently throughout the day calculate the value of the portfolio, which is variable, divide it by the number of shares outstanding, which on that day is a constant, and publish that as the INAV every 15 minutes. The market price is independent of that. It's simply determined by supply and demand, just like the price of Ford stock or General Motors stock is. But obviously, it's not going to get very far away from the INAV because speculator arbitrage is going to pull it back into alignment if it does. And in fact, we have a little slide later on, either for today or for the next time we meet, that shows how that works. So for the mutual fund, the NAV determines the price. For the ETP, supply and demand determines the price, but the INAV is published about every 15 minutes, and arbitrage tends to move the supply and demand determined price close to the INAV. And we'll track it. But as I point out, for various reasons, some funds actually don't track the INAV very well, and that's interesting. And some have a consistent bias at premium or discount. USO, as we'll see, currently has a consistent bias and doesn't track well for reasons that we'll understand later. This means that when you're researching an ETF, and this is the ETF, through its perspectives, you always look at the published premium or discount relative to the NAV as one of the first things you evaluate. If it's got a premium, which is a price that is above the INAV, or a discount, which is a price below the INAV, and the fund family is required to tell you whether it has been consistently above or below the INAV, then you tend to stay away from it unless you understand why it's at a premium or a discount and trade that. And normally you're not going to be able to do that. I'll give you some examples, extreme examples at the end of the lecture, not the lecture today, of where people who don't understand that have gotten into a little bit of trouble on their investments. Now, of course, in the chapter, we took a look at every kind of ETP, or discussed every kind of ETP that we could think of. At the top here, we've got all of these index ETPs, and these are all ETFs, exchange-traded funds. And I'll make the distinction here in just a minute. So every index is represented, including these. DIA is, as I said, one of the stocks I heavily trade. It's a tracking stock for the Dow Jones. SPY is, on any given day, typically the most heavily traded ETF that's out there. About half the days it's at the top. There's 2 or 3 at the top all the time. Gold is at the top a lot. SPY is at the top on most days. And there's an external market fund that I'll show you in the next slide that's on the top a lot. Russell 2000, IWM, if you're trading the spreads between these indexes, you trade those. You say, what do you mean trading the spreads? Well, remember I showed you that they spread apart from time to time. They tend to converge, though, over time. And so one of the more popular kinds of spreads is a convergent spread, where if they get far apart, you go short on the one on top and go long on the one on the bottom, and you make money therefore on the spread rather than the direction. I do that from time to time because they do tend to converge. They'll go like this, and then they'll go like that, like this, and like that, so you trade the spread rather than the value. And then, of course, the NASDAQ 100, QQQ, and so forth. Now, you see all the globals representing every market out there, and we'll talk about some here in just a minute. Brazil, Canada, Euro, France, Germany, South Korea, Japan, Taiwan, United Kingdom. And so these are index-based ETPs, or ETFs in this case, that just draw stocks from those countries. They're like mutual funds of buying only, say, South Korean stocks, or Japanese stocks, or European Union stocks, or British stocks, or whatever. And of course, unlike mutual funds, you can trade all of the metals and commodities, or not all of them, but many of them, directly. Gold is GLD, silver is SLV, oil is USO. If you were trading oil this year, you would take an absolute beating. You would have lost half of your investment trading oil. If you traded gold, you would have almost come close to doubling up. So this is where there's a lot of action, but you kind of have to know what you're doing. You can trade every conceivable kind of yield-bearing financial asset. These we trade also. The 20-year bond tilt, 7 to 10-year note, IEF, 1 to 3-year note, SHY. U.S. Treasury bills, SHV, jump bonds, JNK. These are very, very active. I track all of them. Then you have the technology specialty. And this year we're going to use as the example HACK, which is the cybersecurity ETF. That's kind of interesting. We could use the cloud. And so these are, in the case of cybersecurity, it's a mixture of companies that are tangentially at least in the cybersecurity business, but they include Cisco and the like. So it's not entirely really cybersecurity companies. Cisco has a small part of the cybersecurity market. Cloud, of course, is for the cloud. Semiconductor, software, IGV. That one's really doing poorly this year. And then sector, energy, healthcare, U.S. oil, financial, real estate. And it goes on and on and on. This is just kind of a mix to show you the range of diversity you can find here. So you can bet in a sector. You can bet on an index. You can bet on a country. You can go short, long on any of them. You can go leverage on any of them, or just about any of them, because there's going to be a mutual fund out there that allows you to do it. If you take a look at any given day at the ETFDB.com, you'll see the liquid ETFs. I'll begin making the point, might as well start right here by saying that liquidity matters on an ETF. You have to be very careful if you're trading in illiquid ETFs, because the bid-ask spreads are sometimes very wide, even wider than they are in illiquid stocks in some cases. And these things disappear right and left. 300 or 400, 500, 600 ETFs will disappear in any given year because of lack of trading. And I've never really owned one when it vanished or disappeared, but they generally start performing very poorly just before they do disappear. So you pay attention to volume. So this was October the 8th, and there's SPY at the top where it normally is, but it's not there every day. The EEM is often at the top. That's the emerging markets ETF, which I think is a crazy investment. Then you got Gold Miners Fund, GDX. That's not gold, GLD. Gold is just based on the price of gold. GDX is a bunch of gold mining company stocks. That's a little bit different. And then XLF, financial sector, and so forth. And then you see the TVIX, the 2X VIX short-term ETN. That's probably the most dangerous financial asset out there. If you don't know what you're doing, it's a great way to lose copious amounts of money. And the one just below it, VXX, is an even better way to lose copious amounts of money. And I'll show you why and how a little bit later on. Then you see USO and so forth. So these are the heavy traders, and this gets most of the market action. And most of these are safe, but the two VIX are definitely not safe. So we need to figure out a way to separate the premium ETFs from the not so good ETPs. You'll notice how they end. This is why I make this distinction nobody else makes, right? You notice how the top one says ETF, the next one says ETF and ETF. And then when you get to the one I said is dog crap, it ends ETN. And the one below it is ETN, all right? Those are not exchange-traded funds. They're exchange-traded notes. And it's because of their composition that they are such poor performers. And that's why I'm making this distinction. An exchange-traded fund is typically fairly close to a mutual fund. If it's not actually an exchange-traded fund, if it's an exchange-traded note, it is not. It's not necessarily even remotely related to a mutual fund in terms of its composition. And so we're using the more generic term exchange-traded product, which is an umbrella term that involves them both, until we have some reason to call them what they are individually. The one I'm showing over here on the side is GDX. That's not the one I buy. The one I have is GLD, but you can see it's done very well. That's the gold mining company's individual stocks. Now, when you get to the index ETPs, and a lot of people trade just these, because again, you can trade these doing less research, because as goes the index, so goes your trade, right? So you don't have to know about the company's earnings, or you have to rely upon the guidance and stuff like that. And so if you don't have a lot of time and you're playing a market for its numbers, then this sometimes is what you play, and this is why I played it for the largest part. So normally the way they're set up is they track an index in some proportion that they advertise in advance. And so you can see the top three, the big ones, DIA, SPY, and IWM, are at the ratio of 1 to 10. And you can see at any given point, this was on October the 8th, there was the index and there was the ETF's value at the end of the trading day. So the Dow was 26,164 and the ETF was trading at 261.68. And they are off a little bit like that, by the way. Arbitrage doesn't pull them into perfect alignment. There's another reason, though, why they're off. I'll explain in a minute. S&P 500, again, 289.3, 288.86. But the NASDAQ 100 is traded at 140. Now, others like U.S. oil are not fixed at a ratio. You have to look at the definition of the exchange-traded product to figure out what the pricing convention is for what they use. So you'll see what it is. The price of oil, and this is the oil they buy, which is the U.S. crude, is 52.50, and the ETF on that day was 10.89. But it's not trading at a ratio of 5 to 1 or anything like that. Now, gold trades at 110, but it's not 110 in the index compared to the ETF, because the price of gold was $1,500 per ounce, and the ETF on that same market close was $141.92. That's not 110. Gold, though, works a little differently than some of these in that gold is collateralized physically with gold. The asset they hold to give value to the F is physical gold. They charge a management fee just like a mutual fund charges a management fee, but they take it out by reducing the gold inventory by a tiny amount every month as their payment. And because they do that over a very long period of time, this ratio that they started at, 1 to 10, gradually decays. Now, first of all, you need to understand that that's why they're not at the ratio that they advertise, but it's equally important that you understand that that's not a bad thing, because the decay that you see here represents the decay over the entire life of this ETF, and it's an expense ratio of less than 1%, and it's reasonable. So the fact that they take their expenses out in the form of actually removing some of the commodity and then liquidating it and then paying themselves only matters to the extent that it's a high or low expense ratio. The expense ratio is published, and if it's low, you don't need to worry about this as a problem. The expense ratios mean the same for ETPs as they do for mutual funds, and they should be about the same level. So if it's an index fund, it should be well below 1%, really well below 1/4%. But if it's a commodity like gold, it's going to be up there more like 1%, because it is for mutual funds as well. So that's why I have down there, for some like gold, this relationship decays over time because of fees. This is not undesirable. Bad kerning means that that's bad kerning. That's one of the problems associated with Linux that has not been solved by that nice superstructure. Linux gives you bad kerning. So maybe one of you can make your claim to fame in the Linux world by solving the kerning problem that we have in Linux. To make their prices attractive, they're priced at some fraction of their indexes as shown above. Okay? So now let's introduce ourselves to the notion of long and short ETFs. DIA is when you want to track the Dow, just like buying a DIA type mutual fund. When the fund goes up, the Dow goes up, and you're account goes up by exactly the same percent. Even the same percent, 2 or 3 decimal points, because it consists of the same assets as the index. But if you want to bet on the Dow going down, you buy DOG, D-O-G. It is a tracking stock that goes down by the same percent that the Dow goes up. So the Dow goes up by 0.34 of 1% in a single day. DOG is supposed to go down by 0.34. If the Dow goes up by 2% or goes down by 2%, DOG is supposed to go up by 2%. Now, as we're going to see, DOG, however, is one of these tracking stocks that has a tracking bias, and it doesn't track perfectly over the long run. If the Dow and DOG stay even, if the Dow stays even exactly, DOG will have a slight decay over time for reasons that we'll explain when we look at futures contracts. If you're not happy with that, I didn't replace that slide. I was meant to replace that slide from 2018, didn't. Buy DXD. DXD is 2x long, right? Yeah, DXD is 2x long. So the Dow goes up 1%, DXD is supposed to go up 2%. And S&P 500, same thing. SPY and IVV are trackers of the S&P 500, just like mutual fund. SH is a short, and SDS is a 2x short. Goes down twice as fast as the Dow goes up twice as fast as the Dow goes down. And you kind of get the idea. Small cap, IJR straight away, SBB short, SDD double short. NASDAQ 100, QQQ up, PSQ down, QID double down, and the Russell 2000, all three of these are heavily traded. IWM tracks the index, RWM shorts the index, and TWM double shorts the index. And so you'll find nothing like that in mutual funds. These could be used to hedge, for example. They don't have to be used necessarily for straight investment. Now, the shorts, as we're going to see, are collateralized with futures contracts. That's how they're able to track. And that will become important, but we can't explore why it's important or how it's important until the next chapter. But we will be able to explore it then and understand it. So this was DOG. Remember, I showed you at the beginning of class that the Dow was coming down, and so that's DOG from last year up here, which was going up over the same period of time. When you take a look at the inverse ETPs, SPY, SH, and SDS, you can see they move very well in contra to each other. The blue represents the S&P 500. This is over the last 6 months. This is not a year, this is 6 months. And you can see how this has been a really sideways market for this 6 months, right? We saw last year that we're a little above where we were last year, but not much. And for the whole year, actually, the market's just been oscillating back and forth. So the red is the inverse, and the red, in fact, is the 2H inverse. So if you take a look at that first downturn in the Dow, where the blue goes down, you can see the red is turning up, and that's the inverse 2X, but it's turning up by quite a bit more than the S&P 500 is going down. You can see the green is just a mirror image, right? The green is going up when the red is going, and the blue is going down, and the green is going down when the blue is going up. It's a nearly perfect mirror image. And the red is matching the green, but at 2 times the scale. So if you want to speculate on indexes, there's almost no limit on what you can do, because every one of these indexes has a positive tracker, a double positive tracker, a negative tracker, and a double negative tracker. So speculate away. Again, they can also be used for hedging. If, for example, you want to take a short position in something because on the weekend you're worried that there'll be bad news about Brexit or something like that, and so you say, I don't want to sell my entire stock portfolio just because I'm worried about news over the weekend, but I do want to hedge it, and so you may hedge it by buying SDS. and buying only half as much as you ordinarily would because it's a 2x tracker. So you say, you know, on Friday I'll buy STFs and on Monday I'll sell it off, and I'll just basically be market neutral over the weekend. I'm not going to sell my stocks, but if the stock market tumbles, I'll get a lot of it back by being long on STS. So you can neutralize a portfolio to some extent for any period of time by using these leveraged inverse trackers to do it. And that way you don't have to sell out of your position on a Friday, then move back into your position on a Monday if you're worried about developments over the weekend. And these days you should definitely be worried about developments over the weekend. So this stuff is being very heavily traded. Now they're mostly hedged, I should say, by the way, with futures contracts, not with this. But these are collateralized with futures contracts, so it's pretty much the same thing. If you don't have the right to trade futures contracts, you can hedge with these.
Why do you say you can only hedge your bets to some extent?
Well, because it's got to be matched perfectly to hedge it completely. Right. Okay. First of all, you don't want to. I mean, if you have a $2 million portfolio, you don't want to take the equivalent of a $1 million position in SDS. That's just too big, right? So you can figure out the degree to which you want your position to be hedged and do it accordingly. I mean, moving in and out of the hedge is very expensive potentially, so you got to be careful about doing that, okay? But you can see how this does allow you to hedge a portfolio by example. So that's always an exam question, by the way. How can you use one of these inverse trackers to hedge a portfolio? Or the question might be, you want to hedge a portfolio, what do you use to do it, you know? And so SPY or SDS. Okay, so this is just to acknowledge the existence of these. I've traded this one and the next one a lot. I'm not trading it right now because it's not doing well at all, but I've traded the South Korean ETF, EWY, and this is an example from a long time ago when the news coming out of South Korea was uniformly positive at the time. I don't remember anymore what it was. I remember taking a long leverage position in EWY, and I was trading right in that range right there, and I remember making quite a bit. The stock really climbed. The reason I have this emphasized here, though, is because you need to understand that if you're trading these overseas ETFs, that you have exchange rate risk that matters a great deal. And we'll look at that a little bit later on in the course when we get to futures contracts. By that I mean, of course, you take a long stock position, but you're effectively doing it in the domestic currency, like the won, right? So if the exchange rate of that currency to the dollar changes, that is either going to leverage your rate of return or it's going to work against your rate of return. And we'll give you numerical examples later on to show you how that works. So that complicates this quite a bit. In some cases, though, you decide you want to trade in these stocks specifically because you're trading the exchange rate rather than the securities. For example, you say, well, I don't actually care about whether the stock goes up or down. It's really the exchange rate that I'm trading on this ETF because I know where that's going to move. I've been trading lately, by the way, like this, but I'm trading it directly in futures, and I'm trading the pound. And I'm making a lot of money doing that because the pound's behavior is consistently jagged, but cycling down because of the Brexit problem. I moved into the pound short, always short, when it was about 130, and I've been trading it on cycles because it goes up and down on a downward trend, just following kind of like a mean reversion type cycle on the way down, and I haven't missed yet. And of course, the contracts I'm trading are leveraged like 20 to 1. So for a 1% move, you get a 20% rate of return. If you're right, you have a 20% loss if you're wrong. And you can do the same thing by trading stocks that are in, say, a British ETF, if you want, for example. So sometimes people trade these because of the exchange rate behavior. Sometimes exchange rate behavior is extremely consistent and understandable. For example, the Chinese yuan devaluing is a guaranteed sure thing, or at least it was until it did devalue. And it devalued substantially over the summer. This is an example. I was trading this, EWJ, because of I was trading, in fact, both the currency and shorting the currency and trading EWJ because of the devaluation, which was announced by the Abe administration in November of 2012. They said he was going to take the necessary steps right after an election to restore the Japanese economy. And he started talking about how, and he started talking about using monetary policy. And I said, well, he's saying he's going to devalue the yen. And that's what he's saying. That's what he means. So let's bet on that because he's going to do it. And that was the bet. Long on EWJ, short on the yen. I made both bets, and it was just like printing money. I say, Professor Evans, do you ever lose money? Yeah, I'll give you as many stories about how I lose money as how I make money. I'm just today giving you stories only about how I make money. Later on, I'll tell you about how I lose money. So this was an example that was very, very good. Shinzo Abe engineered a severe devaluation of the yen in December 2012, promoting domestic inflation and huge improvements to corporate profits. It sent the EWJ, look at that, I mean, it's stratospheric, right? That's a big move, too, for such a short period of time. The index there is 950 at the beginning, it was 12 at the end. You're talking about less than a year. And then at the same time, the yen, of course, devalued severely. I don't remember the range, that's somewhere in a later lecture, but it was just as impressive. But now, this is not interesting and not worth trading because that red graph on the side is this same tracking stock over the last year. There's nothing going on because of the crippling effects of these endless trade disputes at the present time. So being involved in trade now is a losing proposition, to say the least. And now this, as you saw, was one of the most popular, EEM. Sometimes it's at the top instead of SPY. I don't understand the popularity of this. This is so crazy and so unpredictable. I have no idea why people are trading this as the highest traded ETP of all ETPs on given days. Look at the swings this thing has gone through in the last year. 44 down to 39, back up to 42, down to 38. And then 40.3, those are huge swings. This is a diversified product consisting of like 100 components inside of it. And it's crazier than AMD or Cisco or some of these stocks that trade wildly because they're just individual stocks. But this one is popular. The reason I don't like it is because nobody here understands anything about emerging markets, what's happening there, what's going on there, politically what's going on. We don't know anything about them. We don't watch the news. We're ignorant about all of this. When the U.S. military is complaining, for example, that we're pulling out of Syria, so the Turkey is going to attack the Kurds. Most people don't know where Syria is. They don't know who Turkey is, and they certainly don't know who the Kurds are, and they don't know why Turkey is attacking the Kurds, and they don't know why that's a bad thing. Because, but you may remember one thing about this, that when ISIS was taking over the caliphate, remember the caliphate from a few years back? I know you're in high school, protected there, but surely you heard about the caliphate. As they were beat back into near oblivion, that's over now because they're making a comeback as of today. They were beat back into oblivion. The death count on that battle was U.S. deaths 6, Kurdish deaths 11,000. Because, of course, we had a proxy army fighting on our behalf, and they did so with the promise that maybe we would help protect them when the war was over, but we just abandoned them yesterday. Now, they're in charge of 12,000 ISIS prisoners and 70,000 ISIS family members. And today they're just announcing they're walking away from those jails so they can congregate their troops to fight against the Turkish onslaught. So ISIS is back in business as of yesterday, so far as I can tell. We don't understand this stuff, so there's no reason to be really investing in these markets all that much. Turkey's a major player in this. None of us know anything about Turkey. Okay. Now to FOSS-related issues, and I'll let you go. Because I'm going to be talking a little bit about the origins of these issues that are going on in computer science now, the history of it and all of that. A lot of that is discussions about old white men, like Linus Torvalds and the right, but not all of it is going to be. And we'll start with someone who's not an old white man, who's probably more impressive than all of them together, and that's Evie Nemeth. Evie Nemeth is basically the goddess of Unix. She was a phenomenal human being who published one volume after the other of the reference books for Unix administration. And she was the only one who did. These big, thick books. So anybody who was ever a sysadmin in a Unix system knew who she was and had her really thick books. She was a professor at the University of Colorado, and she just pumped out these 3,000-page documents, one after the other, in one of the most impressive and phenomenal things. And her books were Bibles to sysadmins in Unix, and then later, ultimately, because Unix led to BSD and Linux, and BSD and Linux. And these are the names of some of the books. And so she was very, very respected. How she died is as bizarre as it gets. And when I was reading about her, I read about her death. She's still missing at sea, although obviously dead by now, because she started to be missing at sea in 2013, on this strange little boat voyage that became very famous because of the strangeness of the disappearance of the boat. I once got distracted into one of the threads that was topical in 2013 following the incident. I couldn't stop reading for 2 days about what happened to this boat in 2013. She was on the boat. It disappeared off the face of the ocean, and she was never seen again, nor was anybody else on the boat, nor was the boat, except they keep picking it up in spy satellite photographs. So if you want to type in Evie Nemeth boat accident or something into Google, then you can waste 2 days of your time reading on the threads of the seafaring journals and so forth about what happened to this famous boat. You can see right here, missing for 5 years and 9 months as part of her life's description here in Wikipedia. But she is to be remembered as one of the most remarkable college professor scholars of all time because of the amazing work she did in putting together these guidelines. You walked into a sysadmin Unix system anywhere, her books were stacked around, and people were always referring to these books. And she just took it upon herself to do it, and nobody's ever accomplished anything quite like it ever since. So we start with her. And next time we'll talk a little bit about Linus Torvalds, who is not missing in a boat and is still alive and is somewhat controversial. All right, we'll see you on Monday, okay? By then I hope I have my computer repaired.
I was the one who emailed you about with my glitch in the computer.
Yeah, did you send the email?
Yeah.
Well, I'll reply to it.
Okay. So, like, how do
Yeah, okay. No, I've got to figure out, there's 3 or 4 of you with special problems.
Okay.
I've got to figure out what to do, but you got to wait for a couple of days.
Yeah.
Because I've got to figure out this computer problem.
Okay, well, do you think it'd be like a regrade or like a retake?
I don't know. Well, it'll work for you though. Don't worry about it.
Okay.
Yeah. I'll make sure that I'll make sure you're not victimized by this.
Thank you so much.
But I can't tell you that's what that's going to be because I don't.
Okay, yeah. I just wanted to notice that. Thank you.
Yeah, I know who you are, and I will fix your problem at some point.
I'm just curious if an ETP is kind of more risky, given that the equity value of your investment now depends on both the supply demand as well as the NAV, and so it's kind of like
It's not more risky really for that reason, except as we'll see when we look at the flash crash, those are what collapsed on the day of the flash crash.
the
ETPs.
ETP.
IWM went to like 2 cents a share, and IWM is the Russell 2000 tracker. So yeah, there's clearly a precedent for the market value issue being a problem for a short period of time. It's insane because, of course, obviously the collateral didn't collapse, so the NAV didn't collapse, and yet the price did collapse. And that's in the it's Appendix A of the chapter.
Based off of how they're trading.
Yeah, just based upon the fact that the bids collapsed.
Yeah.
The bid side of the queue collapsed.
Right.
As you know, that's going to be the problem,
And then
right?
the collateral takes care of the other part.
Yeah.